While India's growth rate fluctuates quarter to quarter and sometimes China posts a higher number in a specific quarter, India is consistently cited as the fastest growing major economy over $3.5 trillion GDP. Here's the breakdown of why, separating the cyclical from the structural. 1. The demographic dividend. The engine. This is the single biggest long-term driver. Unlike China, Japan, or Europe, which face aging populations and shrinking workforces, India is a young country. Median age. 28 years versus 39 in China, 45 in Germany. Working age population. Over 65% of Indians are between 15 and 64. Impact. This means more people are entering the workforce every month than almost anywhere else on Earth. More workers equals more production equals more consumption equals higher GDP. 2. The digital public infrastructure DPI leapfrog. India has built a set of government-backed digital rails that no other large economy has replicated at this scale. This is known as the India Stack. Aadhaar, a digital ID. 1.3+ billion people have a biometric ID. This eliminated ghost beneficiaries in welfare schemes, saving the government roughly $30 to $40 billion annually, which was redirected to capital spending. UPI Unified Payments Interface. This is the real game changer. It allows instant bank-to-bank transfers via phone for zero fee. In 2024, UPI processed over 130 billion transactions. This has formalized the economy, bringing small street vendors into the banking system, improving tax compliance, and making credit access easier. 3. Massive capex. Government investment in infrastructure. The current government made a strategic pivot, stop subsidizing consumption-free electricity and fuel and start building assets. The multiplier effect. Building a highway doesn't just employ construction workers, it reduces logistics costs for factories, allows farmers to get perishable goods to market faster, and increases real estate values nearby. 4. The China Plus One and supply chain shift. Global manufacturers are terrified of relying 100% on China due to geopolitical tensions and COVID-era shutdowns. India is the primary beneficiary of the China Plus One strategy. Apple example. 3 years ago, less than 1% of iPhones were made in India. By 2025, estimates suggest 25% of all iPhones will be assembled there. Why India? Large domestic market. They can sell to Indians, not just export, improving ease of doing business, and production-linked incentive PLI schemes where the government pays companies 4 to 6% of sales if they manufacture in India. 5. Geopolitical neutrality and energy arbitrage. This is an under-discussed factor. Oil purchases. While Europe sanctioned Russian oil, India became one of the largest buyers of discounted Russian crude. India refines it and sells the finished products diesel, jet fuel back to Europe at market prices. This has kept India's current account deficit, the gap between imports and exports, surprisingly low despite a massive energy import bill. 6. Formalization of the economy. For decades, 80 to 90% of Indian businesses were informal, cash only, no taxes, tiny. GST, goods and services tax, and UPI have forced these businesses into the formal tax net. Result: corporate profits as a percentage of GDP are at a 15-year high. This is why the Indian stock market has done so well. Companies are more profitable, they pay more tax, and the government can spend more on infrastructure. C.3. The caveat, the flip side, while the headline GDP number is strong, it's not a perfect picture. Jobless growth. The formal sector is capital-intensive machines, IT not labor-intensive. The biggest challenge is creating 10 million decent jobs a year for the youth. Inequality. The K-shaped recovery means the top 10% of earners, stock market owners, tech workers, are doing incredibly well, while the bottom 50% is still recovering from inflation shocks.